So to answer our question, we are going to start with the additional information. So I hope by now you have a copy of the question so that you can be able to follow. I will also attach it. So it says that additional information number 1 says that the stocks as at 31st December 2021 were as follows: raw materials 9,000, work in progress 8,000, and finished goods 10,350. There we need no working. That is just general information on the closing stock. On number 2, the factory output is to be transferred to the trading account at 25% of factory profit. That we are going to do later in the manufacturing statement. Number 3, depreciation is to be provided at the following rates. So that is our first working, is depreciation. It is provided plant and machinery at 10%, plant and machinery 10% on cost. So we said that if depreciation is provided on cost, that is straight line method. So the cost of the plant and machinery was 30,000 from our trial balance, and this is going to give us 3,000. Then we have motor vehicles. The depreciation is to be provided at 25% per annum, and the cost, because you are providing on straight line method, you are going to multiply with the cost. The cost of the motor vehicle is 16,000. Again, this is going to give us 4,000. That is our working number 1. We can go to working number 2. It says that the amounts accrued on 31st December 2021 for direct labor is 3 million. This reminds me, these workings are in shillings of thousand. Our workings are in shillings of thousands. So the next one you're saying here is direct labor. Direct labor, we have been told it is accrued. Now the first thing is to identify and learn what is an accrual. An accrual is an amount that has remained outstanding at the end of the accounting period, meaning it has not yet been paid. So the figure we are given for direct labor in the trial balance does not include this amount, yet that amount belongs to this period. It is just that it has not yet been paid. So what we have in the trial balance is 28,000. In additional information, you are being told there is an accrual. The accrual is of shillings 3,000. So what we need to do is to add, because that accrual relates to an expense incurred in this period but has not been paid for. So this one we add, and you're going to get 31,000. That is our working number 2. Then we are told further that office rent and rates are prepaid by an amount of 2 million. So again, this leads us to working number 3, where you have office, rent, and rates. So we are being told the amount in the trial balance includes a prepayment, meaning it includes an amount already paid for an expense not incurred. So the amount there in our trial balance of 19,000 includes a prepayment of shillings 2,000. We are saying what is a prepayment? This is an expense not yet incurred but has been paid for in cash, meaning that we are going to incur it in the next period. Therefore, we are going to subtract. So for the prepayment, we less, and we are going to be saying that the amount of that expense in this period is 17,000. 2,000 despite being paid belongs to the next period. It is a prepayment. And those are our 3 workings. Before we move on, we need first of all to know, because these workings are the ones that, or the adjustments that we are going to make in the income statement, we need to also know how these are going to affect the statement of the financial position. So what we need to know is that For the depreciation, this is the amounts we are going to put in the income statement, these workings. But now, in the statement of financial position, what are we going to do? In the statement of financial position, for example, this depreciation that we have here is for this period, that is 2021. But in the trial balance, we had been given that plant and machinery already has a provision for depreciation. We had been given that it has a provision of 12,000. So, during the period, also motor vehicles, we can also bring in motor vehicles. This is the provision for depreciation, for plant and machinery. We are saying it is the provision for depreciation. You have here plant and machinery. This is for motor vehicles. Now, the provision for plant is 12,000. That of motor vehicles is 4,000. And these are the provisions for depreciation. What simply this means is this is the depreciation on those assets that is already existing at the beginning of the year. During the year, we have charged further depreciation of 3,000 and 4,000. So at the end of the accounting period, this is at 31st December 2021, the total depreciation shall be what we had at the beginning of the year according to the trial balance. Then we add the amounts that were incurred during the year. So we are going to add here 3,000. Here we are going to add 4,000. So in the balance sheet, the depreciation you are going to take there is 15,000 and 8,000 respectively. So simply what you are saying, these workings relate to the income statement. These workings or adjustments relate to the statement of financial position. When you come to direct labor, this amount that is accrued here, the 3,000, the accrual of 3,000, we have said this is an amount that has not yet been paid at the end of the accounting period. Accrual means outstanding. Therefore, it is going to be a current liability. That is, it is payable within the next 12 months, that is in the next period. Then this amount here, which is prepayment of shillings 2,000, it is going to be an asset. It is going to be a current asset. This is because it is our amount of money we have paid in advance. So it is our money paid in advance to a provider of a service for an expense we have not yet incurred. So until we come to the next period when you are going to incur that expense, this to us is an asset. It is a prepaid amount. It is our money that is paid in advance. So this is going to be a current asset. It's good we note that these are the adjustments, both in the income statement and the statement of financial position. So to proceed, we can now prepare the manufacturing statement. So we are going to have two columns like that. So a manufacturing statement is simply prepared to determine the cost of manufacturing, to determine at how much cost were the goods manufactured. So the major cost on your manufacturing, number one, is material. So we are going to start with opening stock of raw materials. How much did they have as opening stock of raw materials? So allow me to use the short form for opening stock of raw materials. So at the beginning of the period, the opening stock of raw materials was 7,000. The figures are in thousands. So that means it's 7 million. We have 3 zeros up there. During the year, we also purchased raw materials. So we add purchases of raw materials. Purchases of raw materials. The purchases of raw materials was 38,000. Every time we purchase, we have to check for two things. Was there carriage inward on the purchases? If there was carriage inward, we add, meaning that the purchases were carried in at a cost, which becomes now the cost of the goods, also we add. We also check whether there is return outwards. After purchasing, did we return some of the commodities, probably because they did not fit the description of what we wanted? If there is a purchases returns, we less from the purchases. So in our case, there is no carriage inward and there is no purchases returns. Therefore, adding the two, you get the cost of raw materials available for use. That gives us 45,000. And because we did not use all these raw materials, then it brings us to less the ones we did not use. So we are going to less closing stock of raw materials. Closing stock of raw materials. We are lessing the ones we did not use so that we can get the value of the one we used. So closing stock of raw materials is given as 9,000 there. We are lessing. And then what we get is the cost of raw materials used. Cost of raw materials used. Used or consumed. When you say consumed, it is consumed in production. So how much is that? It's going to give us 36,000. All this is giving us direct material. And we said the other cost of production is direct labor. So we are going to come immediately and now add direct labor. So how much is the direct labor? Remember, for direct labor, there was a working. Do not forget that. As much as in our trial balance, the direct labor was 28,000. Just here, we have shown that direct labor cost had an accrual leading to this working number 2, giving us 31. Therefore, our direct labor here is going to be 31,000. And we are going to write here working number 2. Then we are going to add direct expense. From our question, the direct expense is 16,000. 16,000. So when you add the three of them, that is direct material, direct labor, and direct expense, we said you get what you call the prime cost. So when you add the three, you get the prime cost. So our prime cost is 83,000. 83,000. Okay, so after getting the prime cost, we are going to add manufacturing overheads or factory overheads. Manufacturing overheads, or what you call factory overheads. These are costs that are incurred in the factory but are not directly associated with the product, or they cannot be traced in the final product in an economically feasible way. So in our question, we have that one of them there is factory insurance. Factory insurance, which we are given as 9,000. We are given as 9,000. Another manufacturing overhead that we have here in the previous working is this, the depreciation on plant. The depreciation on plant of 3,000 is going to be a factory overhead. Why? Because plant and machinery is used in the factory, it is used in production. So definitely the depreciation on the plant is a factory overhead. On plant and machinery. So depreciation of plant and machinery, it is going to be 3,000. And it is from our previous working. Here, 3,000. Now maybe you're asking yourself, what about the depreciation of motor vehicles? If you read through the question, it clearly states that the motor vehicles are used in sales delivery. Meaning, motor vehicles are not used in any association with production, rather they are used when selling the products to the external customers. So therefore the depreciation on motor vehicle, we are going to take it to the normal trading profit and loss account as an expense. So it is not used in association with production. That is why it is not a factory overhead. That is the depreciation of motor vehicles. So this is a factory insurance. So in our example, we do not have so many, but others, as we have indicated as I was explaining, would be supervisor salaries, indirect materials, factory lighting, factory rent, all those bearing the word factory would also be manufacturing overheads. So giving us this is a total of 12,000. When we add, we get a manufacturing cost. Manufacturing cost. And the manufacturing cost, which is the sum of these two, is going to be 95,000. And now, because these are the costs that have been incurred in production so far, we need to see out of this, how much of it represents the goods that have already been completed. So at this point, we add opening work in progress. Opening work in progress, which is 5,000. And we less closing work in progress. We less closing work in progress. Remember, we have said we are using FIFO, first in, first out. So opening work in progress was finished during the year, therefore we add. Closing work in progress will be finished next year, therefore we subtract. So whatever we get is the cost of completed goods. Cost of goods completed. Cost of goods completed. So our cost of goods completed is 92,000. Now this brings us back to the additional information number 2. If you remember the additional information number 2, it says that the factory output will be transferred to the trading profit and loss at a factory cost plus 25% profit. So at this point is where we add a manufacturing profit of 25%. So we add a manufacturing profit 25% of cost. So 25%. I want it to be clear, 25%. So 25% of 92,000 is going to give us 23,000. We are going to add it, and whatever now we get is our answer from the manufacturing statement, which we are calling the cost of goods completed and transferred. Completed and transferred. Maybe you're asking, transferred to where? Transferred to the warehouse to be sold. So the cost of goods completed and transferred to the warehouse for sale, because everything about them has been finished, is what you are getting from this manufacturing statement. Now, this is simply the cost of manufacturing. We need to know, what about now when we sell? Do we make a profit or a loss? So that will bring us to prepare the trading profit and loss account. So we prepare the trading profit and loss account. Again, shillings in thousands, shillings in thousands. So now this time we are selling the products that we have already manufactured. So we begin with sales or revenue. The sales figure, the sales is 192,000. And as always, we also check whether there is sales returns. Were any goods returned? In our question, there was no returns. Return inward. Had there been, we would less from this figure. This now brings us to the cost of sales. Cost of sales. We are going to start with the opening stock. This time, the opening stock is of finished goods. Finished goods. So the opening stock we are referring to here is not opening stock of raw material or work in progress. It is the opening stock of finished goods, which we had been given as 6,900. In the place of purchases here, where we add purchases, we are going to add cost of goods completed and transferred. Cost of goods transferred. So from our previous, what you're calling the cost of goods transferred, remember, this organization is not buying things and selling. This organization is producing them and selling them. So this cost of producing them and completing them and transferring them to the warehouse is the one that you are bringing into the income statement as a cost of goods transferred here. So we are going to have 115,000. So here there are no returns. So we are going to less closing stock of finished goods. Closing stock of finished goods. Our closing stock is given in additional information number 1. It is 10,350. 10,350. It is 10,350, and we are lessing. Whatever we get there as 111,550. This is what you are calling the cost of sales. Again, we less from the sales figure, we get the gross profit. Gross profit. The gross profit is of 80,450. Now, one of the issues that we have to note that are unique in manufacturing statement is that among the other incomes that usually we bring here, other incomes, one of our other income is manufacturing profit. So other incomes. We would look for discount received, decrease in provision of doubtful debts, but in our case these are not there. But we have manufacturing profit. This is the profit that we got here. The one that we have here, you add manufacturing profit. This is the one we are reporting here. This 23,000 is the one we are reporting in the income statement. It is a manufacturing profit we are talking about. So we are going to add here manufacturing profit of 23,000, giving us a gross income of 103,450. Then we are going to less expenses. We less now expenses. The expenses that we are going to include here is any expense that was incurred in either administration, selling, or distribution, or any office expense, or any financial expense. So all the expenses that relate to the office, to administration, to finance like bank charges, interest on loans, any expense that was not incurred in production but was incurred in general administration, all of those are going to be here. So in our question, we can see there that there is office rent and rates. Office rent and rates. And before you forget, go back to our first working. Our first working, we can see that office rent and rates had a working here, working number 3. That was reducing from 19,000 to 17,000 because of the prepayment. So the figure we are going to be using is this one, 17,000. That is here. So we are saying that working number 3 is going to give us 17,000. Okay, so do not forget once you do the working, you have to incorporate them. The next one is office lighting. Office lighting, there is 6,000. Then there is stationery and postage. Stationery, postage. Stationery and postage of 2,000. There is office salaries, that is staff, admin staff, administration staff salaries, admin staff salaries of 19,380. And before again we forget, there's one more that we said we are going to bring here, depreciation on motor vehicle. Depreciation on motor vehicles. Why? Because we said the depreciation on motor vehicles, these motor vehicles are used for sales delivery. Therefore, we have said these expenses here are administration expense, selling expenses, and finance expenses. So the depreciation on that motor vehicle is a selling expense, which we had computed in working number 1 as 4,000. So you can go back to working number 1 and see the 4,000. Then we have the final one in our trial balance there. We have motor vehicle running costs. Motor vehicle running costs of shillings 4,500. So the total of all these expenses is going to give us 52,880. So it is going to give us 52,880, which we are going to less. We are going to less from the gross income, what we had here, after adding the manufacturing, which was a gross income of 103, and you are going to get 50,570. At this point is why, in accordance to the prudence concept, remember the prudence concept requires that you do not overstate your profit or your assets, neither should you understate your liabilities. Now, this manufacturing profit here we added 23,000. It represents some component of unrealized profit. For as long as some of the commodities are still not sold, they are still in the closing stock, those items that have not been sold have a component of unrealized profit. So what we do to adjust for that, we are going to add URP is unrealized profit at the beginning of the year for opening stock. And then we less URP on closing stock. So the URP on opening stock was already given. It had been given there as 1380. Yes, the URP on opening stock, provision for unrealized profit as at 1st January 2021. That is the one we are saying is the URP on opening stock had been given as 1380. 1380, so we are adding. But the one on closing stock we had not been given. But we remember we added 25%, making now the goods to be at a 125%, because by the time we were adding 25% markup, the goods were already at 100% cost. So 100% cost plus 25% of the markup, now they are at 125%. So we are saying the URP or unrealized profit is 25% over 125 multiplied by closing stock. Closing stock is 10,350, which we have here. Closing stock is 10,350, and this is going to give us 2070. 2070, which we are going to less. And the answer now we get is adjusted net profit. It is the adjusted net profit, which is going to be 49,880. 49,880. And by the way, had you not been given this URP here on opening stock, we can do it here so that it is visible, you would have also computed it in the same way. It would be still 25 of 125 multiplied by opening stock. Opening stock was 6,900. So this is where you got the 1380. This, as much as it was already given, had you not been given, you would have also computed it the same way we have computed the one for closing stock. So simply, that is how now you prepare the trading profit and loss account for a manufacturing organization. And this leaves us with one thing, the statement of financial position or the balance sheet. So quickly now we can prepare the statement of financial position. So again, I am going to move on to a new tab. So in our new tab, we are going to have here the statement of financial position, which has 3 columns. One column for cost, another column for accumulated depreciation, and then the final column for the net book value. So all the columns are in shillings of thousand, other columns are in shillings of thousands. So to begin with, we are going to start with our non-current assets, or what we call our fixed assets. So our non-current assets, the fixed assets that we have plant and machinery, We also have motor vehicles. The year cost had been given in the question as 30,000 and 16,000 respectively. And now bringing us back to tab 1. We said here that this is what we are going to put in the income statement, the depreciation for the year. But the addition with the previous provision was going to give us what we are going to put in the balance sheet as 15,000 and 8,000. So when we come to our balance sheet, the accumulated depreciation is what you are getting from tab 1 here. It is going to be 15,000 and 8,000 respectively. So once we subtract, we are going to get 15,000 and 8,000. So a total of 23,000. So this is the accumulated depreciation at the end of the year. It is a combination of the depreciation provision given at the question and what we computed during the year in the working, giving us now, and this is going across. It's 30 minus 15, you get 15. 16 minus 8, you get 8. Coincidentally, they just happen to be halfway, but then we can proceed to the next thing, is current assets. Current assets, we said they are consumable or receivable within a period of 1 year, or they are convertible into cash. So current assets in our question, we can start with the bank. So in the bank, we have 16,600. Then we have the prepayment. I hope you do recall. We said there is a prepayment of 2,000 of office rent and rates. So this one is an asset. The next one is trade receivables. Trade receivables, or another name for debtors. Had there been a provision for doubtful debts, we would also have adjusted. But there is no provision for doubtful debts, so we are going to just have 28,000. Then we have stock. This time, our stock is of 3 items. We have stock of raw materials, we have stock of work in progress, and we have stock of finished goods. So for the raw material, there is no issue. We are just going to pick the closing stock as that additional information number 1 as 9,000. For the work in progress, it is 8,000. But for the finished goods, here we have to adjust for unrealized profit. So it is going to be 10,350 minus 2070 of unrealized profit, which you have seen that it contains a component of unrealized profit, giving us 8280. So this total gives us all the current assets as 71,880. So brings us to our current liabilities. The reason we have adjusted for unrealized profit on the finished goods is because, again, we have said we have to be prudent. We cannot overstate the worth of an asset. This 10,315 includes a markup, a profit that has not yet been earned because they have not yet been sold. That profit, which we computed as 25 over 125 multiplied by 10,350 was 2070, which we are lessing so that the asset is not overstated. So our current liabilities, we have creditors from our question. Our creditors was 5,500. And we also have accrual. Remember we said there is accrued direct labor of 3,000. That direct labor was accrued by 3,000, giving us a total of 8,500. So we have 8,500, which you are lessing here. So we are saying current assets minus current liabilities, giving us the working capital. The working capital is 380, which we add to the net book value to get the net assets. Our net assets is 86,380. So our net assets is 86,380. Now, this brings us to the final part of our balance sheet, which is the financed by section. But before then, I would like you to note this 2,000, 3,000, and this. We have already computed them before. We have already discussed them in slide 1, 2, respectively. So financed by we have capital at the beginning of the year. The capital at the beginning of the year was 48,000. Then from the profit, we got a net, during the year, we got a net profit of 49,880. And this profit is what we have just gotten in the previous slide. It is what we have here. This net profit that we have gotten here is 49,880. So then during the year there was drawings, the amount of capital that was withdrawn. And we said drawings is a reduction of capital. So there was drawings of 11,500 by the sole proprietor, leaving us with 86,380, which is the capital employed. Capital employed. So that marks the end of the manufacturing statements. We have noted you have to prepare a manufacturing statement, a trading profit and loss account, and a statement of financial position. If you found it important, kindly share, like, and subscribe. Thank you.